Introduction to Strategic Management Accounting. Introduction to Strategic Management Accounting. Planning and Control. Strategic Planning. Objectives, CSFs, and KPIs. Long-term and short-term conflicts. The role of Strategic Management Accounting in Strategic Planning and Control. Integrated Reporting. Benchmarking. Models used in performance management process. Introduction to Advanced Performance Management, APM. It will be necessary for you to assess different approaches to performance management from different perspectives when studying APM. This will require you to know what the approaches are, and more importantly, you should be able to compare one with another. Introduction to Planning and Control. Planning and control takes place at different levels within an organization. The performance hierarchy operates in the following order. Mission. In a mission statement, an organization outlines its general direction and summarizes its goals and values. Strategic, tactical, and operational plans. To enable an organization to fulfill its mission, the mission must be translated into strategic, tactical, and operational plans. Strategic level. Efforts are focused on long-term planning by senior management, since achievement of strategies affects mission achievement. Tactical level. In middle management, short-term objectives are more detailed over a quarter of a year than at the strategic level. Operational level. Focuses on the day-to-day management of activities by operational managers. The role of performance management in planning and control. Performance management is any activity that is designed to improve the organization's performance and ensure that its goals are met. Prior to establishing a mission and objectives, planning will take place. These should be aligned with the organization's critical success factors. By using performance management techniques, the most appropriate strategies will be put in place to achieve the organization's goals. Strategic corporate planning. A strategic plan involves formulating, evaluating, and selecting strategies in order to prepare a long-term plan of action and reach goals. Strategic analysis, choice, and implementation. Rational model. This three-stage model of strategic planning is a useful framework for seeing the bigger picture of performance management. Strategic analysis. External analysis to identify opportunities and threats. Internal analysis to identify strengths and weaknesses. Stakeholder analysis to identify key objectives and to assess power and interest of different groups. Gap analysis to identify the difference between desired and expected performance. Strategic choice. Strategies are required to close the gap. Competitive strategy. For each business unit. Directions for growth. Which markets or products should be invested in. Whether expansion should be achieved by organic growth, acquisition, or some form of joint arrangement. Strategic implementation. Formulation of detailed plans and budgets. Target setting for KPIs. monitoring and control. Each of these areas will be explored in greater detail throughout the course. Clarifying corporate strategic objectives. The corporate strategic objectives of a business relate to the overall performance and results that the company wishes to accomplish. Role of performance measurement in making strategic choices. The viability of a strategic choice should be assessed using three criteria. Three criteria for evaluating potential strategies. Suitability. Does the strategy have a suitable strategic fit? That is, does it build on strengths, take advantage of opportunities, and will new products fit with existing ones? Acceptability. Is the strategy acceptable to the stakeholders of the organization, both in terms of risk and return? Feasibility. Can the necessary resources and competencies be obtained? Can the organization manage the process of strategic change? The role of performance measurement in checking towards the objectives set. The results of the plans have to be measured and compared against stated objectives to assess the firm's performance. Action can then be taken to remedy any shortfalls in performance. Diagram of performance measurement activities. Senior management. A. Defines objectives. B. Sets targets of performance. C. Formulates strategy. Interpretation into detailed financial models. Budget. Actual result. Deviation from planned activity. Analysis and interpretation. Corrective action. A. Modify targets. B. Review budgets. C. Operating decisions. Objectives, critical success factors, and key performance indicators. Once an organization has established its objectives, it needs to identify the key factors and processes that will enable it to achieve those objectives. CSFs. The organization will need to have in place the core competencies that are required to achieve the CSFs. That is, something that they are able to do that is difficult for competitors to follow. There are 5 prime sources of CSFs. The structure of the industry. CSFs will be determined by the characteristics of the industry itself. For example, in the car industry, efficient dealer network organization will be important, whereas in the food processing industry, new product development will be important. Competitive strategy, industry position, and geographic location. Competitive strategies such as differentiation or cost leadership will impact CSFs. Environmental factors. Factors such as increasing fuel costs can have an impact on the choice of CSFs. Temporary factors. Temporary internal factors may derive CSFs. For example, a supermarket may have been forced to recall certain products due to contamination fears, and may therefore generate a short-term CSF of ensuring that such contamination does not happen again in the future. Functional managerial position. The function will affect the CSFs. For example, production managers will be concerned with product quality and cost control. Classifying CSFs. Classifying CSFs. Internal. Deal with issues within the manager's control, for example, inventory control. Or external. Relate to issues outside of the manager's control, for example, material prices. Monitoring. Used to continuously scrutinize current situations, for example, actual performance versus budget. Or building. Look into the future of the organization and its development. For example, the development or launch of a new product. KPIs. KPIs are essential to the achievement of strategy since what gets measured gets done. That is, things that are measured get done more often than things that are not measured. Features of good performance measures. Features of good performance measures. Measure effectiveness of business in achieving objectives. Measure efficiency of resource utilization of the organization. Contain internal and external performance measures. Comprise a mix of financial and non-financial methods. Link to targets set for employee motivation. Cover short and long-term organizational performance. Should be flexible in order to respond to changing business environment. Make clear the different dimensions of performance so that trade-offs, for example, between cost and quality, are clear. Long-term and short-term conflicts. Strategic planning is a long-term, top-down process. The decisions made can conflict with the short-term localized decisions. It is common for divisional managers to be rewarded based on their short-term results. Therefore, motivating managers to achieve long-term strategic goals will be challenging. Divisional managers need to be able to take advantage of short-term, unforeseen opportunities or avoid serious short-term crises. Strict adherence to a strategy could limit their ability to do this. The role of the strategic management accountant in strategic planning and control. The strategic management accountant plays a key role in performance management, helping to determine the financial implications of an organization's activities and decisions, and in ensuring that these activities are focused on shareholders' needs for profit. Changes in the role of the management accountant. Helping to establish KPIs and to analyze information to draw out patterns and insights for those who use the information. Communicating these insights in an objective and responsible way to influence the organization's decision-making. To help to apply these decisions to harness value for the organization through its strategic planning and control. The modern management accountant will no longer work in isolation, but will work with others from across the organization in partnership to derive long-term strategic success. Can management accountants cope with this shift? The modern management accountant will need to successfully combine traditional technical accounting skills with business, people, leadership, and digital skills, all underpinned by ethics and professionalism, but is well positioned to meet the changing mandate since it has a unique end-to-end view of the organization, understanding that every activity has a financial consequence. Its accounting information is trusted and credible. It already provides a framework for performance management through management accounting. Benefits of the changes for performance management. From an organization's perspective, the accountant will be a guide to the strategic business unit manager to ensure that strategic goals are reflected in performance management. The management accountant will take a supporting role in assisting strategic business unit managers in getting the most from their management information system. This will entail the accountant understanding the needs of the particular manager and then working with them to extract valuable reports from the management information system. Role of the management accountant in providing information to stakeholders. The triple bottom line. Whilst all businesses are used to monitoring their profit figures, there are also environmental and social aspects to consider in the longer term. The triple bottom line focuses on economic, environmental, and social areas of concern. Area of concern: economic performance. Explanation: the management accountant must monitor the financial performance of the organization to ensure its continued prosperity and fulfillment of shareholders' needs. Area of concern: environmental performance. Explanation: improved environmental practices may include taking steps to reduce waste, increase recycling, and use energy-efficient equipment. Area of concern: social performance. Explanation: many activities don't have to cost the organization much. For example, giving staff time off every year to volunteer for charitable causes, but can have far-reaching social benefits. Integrated reporting. The management accountant's role in providing key performance information for IR. IR will bring statutory reporting closer to the management accountant and will make management accountants even more important in bridging the gap between stakeholders and the company's reports. The management accountant will be expected to produce information that is a balance between quantitative and qualitative information. The information system must be able to capture both financial and non-financial measures. Links past, present, and future performance. The forward-looking nature will require more forecasted information. Considers the regulatory impacts on performance.